Hi everybody, welcome to a discussion on this topic which is development of financial strategy. Friends, this particular topic is actually speaking, talking about the discussions that happen with respect to finance at the topmost level, at the strategic level, of course, where of course the CEOs and the CFOs and the entire board is looking at three key decisions about the business finance. Okay, these decisions would relate to financing, investing, and dividend decisions. Okay, when I look into this flow, here we are safely talking about, first of all, that a company is actually speaking very seriously considering at all times how should it be financing its business, how should it be funding its business, what are the sources of those funds where from the money can be originated and of course used in the business. Okay, so when I say that I'm looking at the financing part of it, we keep it more focused to the long-term requirements, maybe in form of debt or in form of equity. Okay, when I go to the next decision making, I'm looking at, of course, the investing decision. We talk about, of course, evaluation of proposals in terms of how should the company be evaluating any specific investments, any specific proposals, any specific projects. What are the means through which, what are the ways through which such investments can be evaluated, whether they are good to the business or are they not good for the business. Okay, and finally, and probably very challenging decision is to decide whether to pay dividends, and if yes, how much. Right, the very idea of this decision making is becoming more challenging as against financing or investing, is that while the cost of financing can be determined, can be ascertained, while the project evaluation as far as investment proposals are concerned can be done through some parameters, dividend decision is not binding on an entity, right? A company is never mandatory required to pay dividends to its shareholders, but then this becomes one of the most important decisions for many organizations, actually speaking, for the very reason that the shareholders also have an expectation of a return, and that is where you need to assess whether or not should you be paying dividend, and if yes, how much should that dividend be? Is it going to be a fixed proportion of profits? Is it going to be a fixed amount per year? Is it going to be growing over a period of time? And that is where this decision is rather more challenging sometimes. Okay, so when I say that, I'm looking at the very objective of financial strategy. I'm safely saying that it is a financial strategy is nothing else but at all times deciding about these aspects, at all times taking decision with respect to financing of the business, investing into projects, and of course payment of dividends. Okay, at this point in time, we should also be talking about, of course, why probably these financial decisions really take it all for the finance manager or the CFO level. Here we are saying that when you are considering proposals, right, you need to assess, of course, at all times whether the projects that you are taking what kind of risks that are involved in those projects. Okay, do those projects and the risks associated with those projects meet organizational objectives or not? Okay, we're also looking at possible change in the shareholders' wealth when you undertake these kinds of projects. Okay, you need to understand, of course, at all times with respect to such projects, that does the company have sufficient liquidity at all times? Is the company able to make profits out of such projects for that matter? And you also look at the sensitivity of cash flows attached to such projects. Okay, when I say that, for example, I'm thinking of a scenario where we say that there is an infra company let's say XY that undertakes a project to build or construct a toll plaza or toll bridge. Okay, now the way, for example, the business model for such projects work is that the government would allocate or allot a piece of land or space wherein this toll plaza would be constructed, and it's an entire investment made by the company over the construction period. The company may or may not receive any returns during that period, and it is expected that the returns would only follow when people use that toll plaza. Okay, so there is a big dependency that we have on those number of people who are going to use that toll road or toll plaza and pay for those. So there is a lot of risk involved in this kind of a project, and it has to be assessed whether such companies organizational objective meets undertaking these kind of projects at all. And you also try to assess whether you have sufficient money to be able to construct and undertake that project. Does this project appear viable? And if there's a change happening in those assumptions with respect to the number of expected users, the sensitivity of cash flows is a very essential, important decision that one needs to look at. So when you talk about evaluation of proposals, investment proposals, you really need to understand and assess whether this project is eventually going to be very beneficial to the business or not, in terms of, let's say, whether does it increase the investor's wealth or shareholders' wealth or not. Okay, now having said that, we start now looking at it. We want to invest into a project. Where will the money come from? Okay, and that is where you start considering, should you borrow or should you use your own funds, or maybe a mixture of both. Okay, so again you start looking at it from long term as well as a short term requirement. This is where you start talking about the relevance of working capital into consideration. And then we said, of course, when you are talking about a debt, what type of debt are we now looking at? Is it going to be bonds? Is it going to be commercial papers? Is it going to be, within bonds, for example, we may have convertible bonds, we may have zero coupon bonds, ZCBs, or other types of bonds. You look at all these things. The features would be important. Start, of course, considering the gearing ratio in that. What is my debt proportion out of the total money that I'm using? And higher gearing is rather a riskier indication. So I need to really assess all these things when I'm sitting in and deciding upon my financial strategy. Okay, when you look at equity, again you start looking at how do you bring equity. Are you looking at something like equity shares or preference shares? Are you going to use some accumulated profits, retained earnings, stuff like that? Okay, having even talked about this more, we start looking at it that at all times you just need to ensure that you have, for example, sufficient money available with you, right? That is something which is the expectation of financing, right? You need to have sufficient money at all times because you need to be liquid, you need to be able to pay your routine liabilities and even your long-term liabilities at all times. You cannot afford to delay payments for the payments which are for the expenses or liabilities which fall due, right? It could also be an expectation that you need to carry sufficient money at all times so that you can meet any unexpected costs. So this is where you start considering the relevance of the liquidity coming in through financing. Okay, you can't again at the same time have significant amount of money which is not used by you, which is not, let's say, not like, which is lying idle. You can't just do that. There are big businesses, of course, which keep on looking at their set of their amount of cash that is available to them. So you need to really kind of look into that consideration when you talk about the financing decisions, of course. Okay, of course you cannot borrow too much at all times, and at the same time, of course, you look at the other aspects. Dividends, yes, as we said, whether to pay dividends or not, and if yes, then how much. Start measuring it. This is again a means or ways to return or to offer returns to shareholders, right? If a company is not really growing very fast and it is not really able to generate a significant amount of growth, over a period of time, then it could be a wiser decision to pay dividends. So that is where you start looking at it. Of course, if the company is going very fast, it has a lot of opportunities available wherein it can grow further, so it might retain cash and not pay dividend. Okay, but in such case, the company has to ensure, the management has to ensure, the financial strategy must ensure that the wealth of the shareholders is increasing, in some other manner. For example, the value of the share prices are increasing considerably. That could be another way when you do not want to pay dividends, right? If I really go back to the first equation where we say that we should pay dividends, another important question that comes is how much of the dividend should be paid. Okay, so you look at all these things coming into this discussion and just ensure that you are looking at all these three things together when you look at, of course, evaluating your financial strategy. They are quite interrelated, as we would agree now, for an obvious reason that if you are investing into a project, right, you need some money for that. Okay, and then whatever profitability you are able to generate, you may need to pay something back to the shareholders, and when you start paying this, there's again a pressure on the financing side, because the dividend payment essentially means a cash outgo. Okay, so you need to really be kind of looking at these things very closely to be able to determine in terms of how do you take these decisions and try to kind of obviously judge that, right? Another important consideration, we'll see the interrelationship coming in. If, for example, the finance costs are too high, then of course the dividends may be restricted in that case. Okay, it can be another scenario where we say that if there is too much of a gearing, then there could be a restriction to pay dividends by the companies also, right? So we really kind of look at all these things come into the picture. Likewise, if I may say, there are sufficient investment opportunities, then why probably you would want to pay dividends at all? So this is where you start looking at all these interrelationships being built, and you tend to, for example, bring that perspective within these three decisions in terms of, should you be paying dividend if there is too much of investing opportunities, or if the fund costs are too high? So that could be, again, let's say, a choice that needs to be made, and accordingly you move forward on those, let's say, options for that matter. Okay, if I say that I'm looking at or trying to kind of look at these relationships, I may want to kind of add some more parameters to this so that we can really bring some assessment to our decision making in terms of what all factors influence these decisions. Okay, so when I say that I'm looking at those factors per se, we are saying that what influences my decisions around these areas could be driven by factors including government influence. Okay, it could be including maintaining good relationship with investors. I'm going to explain that a bit in a minute. Okay, there could be some debt covenants. When I say covenants, I'm talking about kind of conditions or restrictions coming into the picture. Okay, it could be, of course, your accounting requirements. Okay, we may look at, for example, the could be a thought process around capital structure. So maybe it's covered through the debt covenants somewhat, but maybe, yeah, I think so. We may say cost of funds. So I would say capital structure as well. Okay. So when you look at all these aspects, maybe even to some extent it's looking at regulatory aspects. So they may all influence my decision making. Okay, let's try to explain these terms one by one and see to it if we can really connect with these aspects here. So if I say, for example, to begin with, on the government influence, right? When I say I'm talking about the government influence, think over it like this, that the tax rates may vary as far as profits and dividends are concerned. Okay, so when you look into all these things, that's where you start considering the tax rates on dividends. There could be, again, let's say more stringent reporting requirements, okay, wherein we start looking at specific investments on corporate social responsibility projects. Okay, so what we are trying to say is that if I were to, let's say, do investing or dividend or financing, I may come across a lot of considerations that I need to use, or that I need to take into my mind before I'm able to take such decisions. I mean, so life is not that easy when you look at the government influences. Of course, there could be restrictions on dividend payments. For example, if I say that a company has a parent company which is in a different nation, and the government prohibits any such dividend payments, or it can happen that the tax rates are way too high when such profits are sent back to the other country. So look at all these things directly impacting the dividend decisions and likewise. Okay, so when you say you're looking at that aspect, yes, it impacts your business decision making, and of course all these things would have their own challenges here. If you look at the investing part of it, government influences, you may have some tax laws which allow you some rebates, or there could be some restrictions on the foreign direct investments and stuff like that. You may not be allowed to, as a foreign company, for example, in some jurisdiction, you may not be allowed to raise funds from public at large. So this could be a big influence by the government on all these three types of decision makings. Okay, when you look at the maintaining a good relationship with investors, here you start looking at it, how to keep primarily shareholders happy. Okay, what are you going to do to kind of make them happy? Of course, you start considering dividend payments could be one way in which you sense that the shareholders might like the idea, but at the same time you're looking at, of course, increase in their wealth. Okay, now if I say that the investor, the company has limited number of shareholders, okay, it's a private setup or a family setup, so naturally the influence comes in where you expect the the top management seeking more and more dividends rather than increase in the value of the shares, because that's what they expect to receive immediately. So that would affect your decision making, right? And when you're paying more dividends, which means that you have lesser cash available for investments. But having said that, you might want to borrow again to fund those investments, and this cycle keeps on going. So the primary investors again need to be made happy about it. In a larger setup, in a large listed company, you may or may not always want to pay dividend. As such, you know that not every shareholder would be able to push the board of directors on the payment of dividends. So over there might be a bit of a flexibility, but you still want to kind of ensure that their wealth is getting increased. Okay, the debt covenants safely talk about there may be some positive covenants wherein the lenders, the people who have provided you the money, they may expect you to ensure that you are able to kind of generate sufficient profits, maintain right return on capital employed, net profits, EBITDA, etc. Okay, there could also be some negative covenants, restrictions. For example, you may not be allowed to there could be a restriction on dividend payments, right? There could be a restriction on further borrowings. Okay, so in that sense, financing and dividend payment may get influenced by, of course, the debt covenants there. Okay, if I look at the accounting requirement very clearly, payment of dividend can only be paid out of my book profits or accounting profits. That is one requirement of accounting. And likewise, when you look at different ways in which you do the financing, so it can happen, as we understand accounting differently, it can very well happen that even if you are issuing shares, that might be shown as a liability sometimes. Okay, so from those perspectives, your proportion of liability versus equity, that keeps on getting changed with the need of accounting requirements as such. Okay, looking at the next point, when it's a cost of funds, of course, a higher cost may restrict dividends payments, or even considering how to go for additional borrowings or additional investments. You really need to kind of look at very carefully the sensitivity of that cost. If it is really changing fast and on the adverse side, you might have some challenges associated with that. Okay, Likewise, if I look at the capital structure, I think very, very clearly we need to measure it. What is the optimum capital structure that needs to be assessed when you say that you are trying to run a business, trying to run an enterprise, and build, of course, a proportion of debt versus equity. Okay, regulatory aspects, I think very clear implication where you look at the role of taxation on business. Okay, while there is a tax rate on dividends that we try to talk about in the government influence, the regulatory aspects require you to, of course, look into the tax implications. Okay, be it your let's say, be it your profits, be it your capital gains, be it your disallowances, or maybe even talking about, for example, taxes paid by a foreign company. So the change in those regulatory requirements really impacts your financing, investing, and dividend decision making. Right? Normally, it is said that any interest is tax deductible. Now, clearly, when you say that you have this point valid, so it's desirable in an economy where the interest rates are higher to actually, or the tax rates are higher. It is desirable to borrow more because you know that you're able to save more taxes by making the interest payments. Okay. On the other hand, if the dividend payments are actually taxable in the hands of shareholders, it might be seen, it might need to be considered whether should you be paying dividends or not. If, for example, the tax rate on the capital gains by means of, let's say, sale of shares is less taxable or is taxable at a lower rate, then naturally it could be a different decision making altogether, right? So broadly, when I look into this aspect of development of financial strategy, my key focus, as we said, lies onto this circle, which is investment decisions, where to invest, what risk, profitability, liquidity, and how to fund that project short term, long term through debt or equity. And then if the project is successful, then should you be paying dividends? If yes, then how much? That is something which we wanted to discuss in this brief point where we talked about the different variables into consideration. Very generic topic, but when you go into the specific parameters, when you look at the cost of funds, when you look at, for example, let's say the capital structure, when you look at let's say equity or debt, in terms of their individual stances, then you try to understand in terms of how should the CFOs or the CEOs be taking decisions on such parameters. Okay, so that's something that I wanted to cover in this discussion today with you. Should be looking at some more discussions around the subject through some other lectures later. So that's it from my side, and good luck with your preparation, good luck with your learning, and all the best. Good day. Take care. Bye.